This video and the next are about blame. With regard to the recent bank failures in the States, Fed officials and others have tried to point the finger at depositors who've been taking their money out of banks. Their aim has been to make them out to be the bad guys in this scenario, but the depositors are not to blame. They're only reacting to the present economic situation. The real villains are the central banks and governments. They're the ones to blame. They're the ones responsible for this horror show that we're in. Permit me to explain. All we need to do is pan out and get some perspective and see what's been happening over the past however many years. Interest rates and money supply are the two principal levers central banks use to manage, I would say control, the economy. To my mind, there shouldn't be any central banks at all. The market should determine interest rates, not central banks nor any governments. But anyway, they do at present, so in this video we'll look at interest rates lever, and in the next video we'll look at the money supply lever. Before we get into it though, as a little light-hearted aside, you might want to think of central banks being like the wizard in the film The Wizard of Oz. In this video and in others, I'm endeavouring to do what Dorothy's dog Toto did in the film. I'm pulling back the curtain. And what do we see? We see the Wizard of Oz. Before him is a giant machine with flashing lights and various dials. Although in my version of the film, I want you to imagine two great levers. One lever is labelled interest rates and the other is labelled money supply. So let's look at the interest rates lever. What is supposed to happen is that the Fed pulls the interest rates lever when the economy is overheating, and they push the lever in the opposite direction when the economy needs stimulating. Low rates are supposed to be used to stimulate a sluggish economy, thereby avoiding the worst effects of a recession. The Fed had kept interest rates low for an awfully long time, for reasons I won't go into here. From 2013 until last year, rates had been exceptionally low. This policy of low interest rates has meant that the money was cheap to borrow. This stimulated the economy, but importantly, it also created bubbles, especially in the housing market and the stock market. Prices for real estate have been bonkers for a long time, but when the Fed started to raise rates aggressively late last year, that caused a turnaround in the market. I should perhaps say that the housing market is a sector which is particularly sensitive to changes in interest rates. The stock market has also been hugely overvalued. Stock prices are artificially inflated. The value of equities has been pumped up by the Fed with the availability of cheap money. While we're on the subject of the stock market, I want to say that the stock market is not the be-all and end-all of an economy. It's only one sector. Moreover, to my mind, it's a relatively poor representation of the real underlying economy and has been for some considerable time. Indeed, I would go as far as to say that there's no proper connection between the stock market and the economy, to the extent that the stock market can almost be regarded as an entirely separate entity to the economy. Anyway, there's what could be described as an over-exuberance in the stock market for a while. It's due for a massive Mother Nature-style market correction at some point in the not-too-distant future. It's my belief that stocks and shares will go to true market value, dropping by around 80% from their highs. So, when the real estate market and the stock market crash, then we need to know who to blame. I should also say that the policy of low interest rates has created an environment of risk. If interest rates are kept artificially low by central banks or governments intervening in an economy, investors struggle to find decent yields anywhere. This inevitably pushes investors towards riskier, higher yielding investments and away from safer, lower yielding investments. So keeping interest rates at low levels introduces more risk into an economy than there would otherwise be. Ever since the financial crisis of 2007-2008, central banks around the world have generated significant systemic risk into the world economy. That's where we're at now. Moving on, let's turn our attentions now to the bank failures that occurred in the States recently. The raising of rates from late last year directly led to the present banking crisis. How so? Well, one thing to bear in mind is that the value of bonds is linked to interest rates, so their value in the marketplace is dependent on whether interest rates are high or low. When the Fed funds rate is low, the yield on the bond is low. How bond prices are determined is a hugely complex topic and beyond the remit of this video. Be that as it may, all we really need to know is that there's an inverse relationship between yields and prices. Picture the situation like a seesaw, so when yields go up, prices for bonds go down, and vice versa. When yields are low, bond prices are high. Anyway, interest rates have been low for a good number of years, so bonds were offering low yields. Low yields mean high prices. The problem is that in 2022, the Fed began to aggressively raise rates. The yields started to go up. The prices for bonds went down. Therefore, the market value of the bonds held by banks in their reserves became lower. The value of their capital reserves declined. These are known as unrealized losses. This needn't be a big problem, provided that the bondholder holds the bonds to term, because when the bond reaches its maturity date, the government pays out the amount owed. No big deal. But what if the bank needs to raise cash all of a sudden, for whatever reason? To raise funds, they have to sell these assets. But why would any investor want to buy these old, lower-yielding bonds when new bonds with higher yields are on offer in the marketplace? The short answer is that they wouldn't. The result is that to find a buyer, the bank is forced to sell the old, lower-yielding bonds at a significant discount. This is basically what happened when depositors started to withdraw money. Banks needed funds to cover the costs of the withdrawals, and they had to sell their bonds at a loss. The losses were huge and they got into serious trouble. Banks in the West have, generally speaking, not really been regarded as risky propositions, at least not in the past 100 years or so. So when you put money into a bank, you might not have considered your money to be at risk, but that is no longer the case, thanks to the Fed et al. In summary, I should perhaps say that the ideal situation is to have a stable economy, one which ticks along without much drama. One of the main arguments for having a central bank is that they are supposed to promote stability in the financial sector and the wider economy. So perhaps a valid question to ask is, how effective has it been in stabilising things? I would argue that central banks around the world have not only been ineffective in stabilising things, but have actually created a great deal of instability. This instability might not be apparent, especially as our overlords have done their best to keep it hidden from the general public. They have done their utmost to manage people's perceptions. So, there we are. We're living with the consequences now. Myself and other commentators have predicted an almighty crash to occur sometime soon. The structural instability that they have created will then be revealed. When the crash occurs, then we have to blame the Fed and other central banks. Make no mistake, they are responsible. They are the culprits. To finish up, returning to the film The Wizard of Oz, the old man acting as the wizard says to Dorothy, "Do you presume to criticize the great Oz?" To which I would respond, "Yes, I fucking do. Wise up and rise up."